come to IFRS 10, one of the most important standards for you, Consolidated Financial Statement. And through this chapter, we will be able to test your knowledge of other standards also. In some problems, there may be adjustment relating to PPE or investment, or intangible assets. So this chapter is a means by which the examiner can check your knowledge of many other standards also. So first we will learn the basic concept behind consolidation. Consolidated financial statement means when there is a parent company and there are subsidiary companies, we prepare the financial statement of this parent and subsidiary as if it is a single enterprise. What would have been the financial statement had it been a single enterprise? Investors are interested in consolidated financial statement if the parent operates through subsidiaries. The performance of the group, the financial position of the group will be known by looking at the consolidated financial statement. Consolidated financial statement shows as a group how it is performing, what are the resources it is commanding. So in case if you want to invest in a company which has got subsidiaries, etc., then not only look at their separate performance, also look at the group performance. So that is the whole objective of having a standard like IFRS 10, because in this standard we will learn the principle for presentation and preparation of consolidated financial statement. So we will call it CFS in this chapter. In short, consolidated financial statement when an entity controls one or more other entities. So the entity which are being controlled are called subsidiaries, and the entity which is controlling the other entity is called parent company. And the outside shareholders in the subsidiary company other than parent and other group subsidiaries are called non-controlling interest. This standard works on the principle of control. If there is a control, apply this standard. This standard defines control for all entities that could be consolidated. Of course, there are some exemptions where this standard is not applicable. Like this standard is not applicable for accounting requirement for business combination and their effect on consolidation, including goodwill arising on a business combination. So if a subsidiary is acquired, first you apply Ind AS 103. If a subsidiary is acquired, first we will apply Ind AS 103. Ind AS 103 will guide you how to calculate goodwill, how to calculate NCI on acquisition. After that, the consolidation will be done under this standard. So what is the role of 103 here? They will help you to compute goodwill, NCI on the date of acquisition. And then which standard will take the charge when it comes to the consolidation activity? Only IFRS 10. There are 5 standards which are used in the consolidation process, preparation of consolidated financial statement. So our main topic is IFRS 10, consolidated financial statement. In case if we have joint arrangement and the joint arrangement is in the form of joint operation, then we will apply 1:1. If it is investment in associate and joint venture, then we'll apply IAS 28. In the separate financial statement, that is when we are not preparing consolidated financial statement, 27 will apply, and there is a comprehensive standard on disclosure which contains disclosure related to subsidiary, associate, joint ventures, investment entities. All disclosures will be covered under this standard. Okay, so one single standard to cover disclosure requirement under other standards. The focus of the standard is substance over form. If you really look at the form, there are different entities. This consolidated financial statement is one of the best examples of substance over form. In form, there is A, B, C, but in substance, they are one only. So it is presented as if it is one entity. The objective of this standard is to establish principles for presentation and preparation of CFS when an entity controls one or more entities. What is the objective of the standard IFRS 11, which is called joint arrangement, is to establish principle for financial reporting by entities that have an interest in an arrangement that are controlled jointly. So IFRS 11 is applicable when there is a joint control. Then there is IFRS 12, which is for only disclosure requirement. Then there is IAS 27, which is to be applied for accounting in separate financial statement when the entity has subsidiary, joint venture or associate. And then another important standard is IAS 28, where we will discuss the accounting of investment in associate and joint venture using equity method of accounting. Once we learn this chapter IFRS 10, then we will learn IAS 28. And then the game will become more complicated. Why? Same entity will have one subsidiary, one associate, one joint venture, and then you have to do the consolidation. That also we'll do in the standard IAS 28. Okay. The scope of the standard is a parent who controls one or more entities is required to present consolidated financial statement. A parent who controls one or more entities is required to present consolidated financial statement. That is the scope. So if it is identified that you are controlling one or more entities, then you have to apply the standard. Okay, in the books of parent, you have to apply the standard. Once it can be demonstrated that this party is controlling one or more entities. However, there is an scope exemption. In some situation, you may be a parent, you may have a subsidiary, but you are not required to prepare CFS. Subject to you meet following 4 conditions. All 4 conditions are compulsory. If any of them is not satisfied, then you have to again prepare the CFS, right? So, should we remember this? Yes. For a theory question, maybe you have to answer this question. Under what conditions a subsidiary is not required to be consolidated? So, a parent is either a wholly owned subsidiary. Parent is either a wholly owned subsidiary or a partially owned subsidiary. So you write down the entity is. The entity is, or even the word parent is okay because it is in the context of consolidation. Okay, no problem. So suppose H Limited, P Limited, S Limited, S1 Limited. So we are talking about this company. We are talking about which company? S. So S Limited has a double role here. It is a parent of a subsidiary S1 and subsidiary of a parent P, whose ultimate parent is H. Okay. So we are talking about S. Parent is either a wholly owned subsidiary. Suppose P Limited holds 100% share. Or for example, let us say there is another company. This is another example. P1. It holds 80% share in S. Either or. P Limited is S is either wholly owned subsidiary or a partially owned subsidiary of another entity. Further, its owners, including those not entitled to vote, have been informed and do not object to the parent not presenting the consolidated financial statement. So it is a wholly or a partially owned subsidiary, and its owners. Who is the owner? In case of this first example, P is the owner. In case of this second example, P1 and NCI, outsiders holding 20%, they are informed and they do not object to the parent not presenting the CFS. Okay. First condition is that your owners are not objecting to you not preparing the CFS. Second condition is the equity instrument or debt instrument of the parent are not traded in a public market. So it is not a listed entity. The public market could be a domestic or a foreign stock exchange or an over-the-counter market, including local and regional market. So it can be any market. It can be a listed stock exchange. It can be OTC market. Sometimes there are SMEs also, small and medium exchange trading platform. It should not be listed anywhere. And the third point is, it should not be in the process of getting listed. How do you know whether it is in the process of getting listed or not? The parent has neither filed nor is in the process of filing its financial statement with the Security Commission or other regulatory organization for the purpose of issuing any class of instrument in the public market. So this you can find out from the legal department of that company, that have you filed any document with the, in India, SEBI, in other country it is called Securities and Exchange Commission. If you have filed any such document which indicate that you are in the process of getting listed, then this condition number 3 is not fulfilled and you will have to prepare the CFS. And fourth condition is the ultimate or any intermediate parent of the parent that is required to prepare CFS produces financial statements that are available for public use and comply with IFRS. In which subsidiaries are consolidated or measured at fair value through profit and loss in accordance with IFRS 10. Now we'll take the same example, H, P, S, S1. Now this paragraph says, you are S Limited, you are parent of S1. Okay, so the question is from the point of view of S, who is a parent of S1. Assuming first three conditions are satisfied, what is the last condition? That either your parent company P or your ultimate parent company H, they prepare financial statement that are available for public use. That means public can approach that financial statement, can get access to those financial statement, and which are IFRS compliant, in which the subsidiaries are consolidated or are measured at fair value through profit and loss in accordance with IFRS 10 or IFRS 9. Okay, that means suppose this parent company prepares CFS. Below you will see there are some entities who are allowed to show the subsidiaries at every TPL if they don't want to consolidate that subsidiary. So P may have many subsidiary. Suppose it has not consolidated as, it has shown it as FBTPL, then also it is okay. But at least it is preparing CFS which is available for public consumption, public view. Then the standard is also not applicable to post-employment plan or other long-term employee benefit plan to which IS 19 applies. And between that there was one more paragraph. A parent who fulfills the following two conditions are also not required to prepare the CFS. Which is this example? Parent is an investment entity. This we'll see in the last few paragraph also. Investment entity. Investment entity, for the timing, its principal business is investment activities. That means their performance is evaluated by how the investment is performing. They are not involved into day-to-day business activities. And second condition, the parent is required that to measure all its subsidiaries at every TPL. So investment entities are also exempt from preparation of consolidated financial statement. Now one case study is appearing below. Solve. This is just one example. They can create questions like this. So you have to keep all four conditions in mind and see how many of them are getting satisfied. If all four of them are getting satisfied, then that entity will be exempted from preparation of CFS under this standard. Entity X owns the following other entities: 100% interest in entity Y. Entity Y owns 60% interest in Z. Then entity X owns 80% interest in M. Entity M owns 60% interest of entity N. So this I will present in the form of a diagram which is easy for you to understand. X Limited holds 100% in Y, 80% in M, Y Limited holds 60% in Z, M Limited holds 60% in N. So what is the next paragraph? It says entity X is listed company and therefore it prepares IFRS compliant CFS, no problem. Entity Y and M do not have their securities publicly traded and are not in the process of issuing security in public market. So condition number 2, 3, 4 has got satisfied. What was 2? You should not be listed. 3, you should not be in the process of getting listed. 4th was your parent company prepares CFS for public use. Entity X, and the first condition is that the parent or the NCI do not require subsidiary M to prepare the CFS. Now tell me whether subsidiary M can be exempted from preparing CFS? Yes. Entity Y is a wholly owned subsidiary of entity X. Entity Y is not required to prepare the CFS. Okay. So now we have to answer whether these companies Y and M can be exempted from the requirement of this standard. Entity M is not required to prepare CFS provided the NCI holders have been informed about and do not object to entity M presenting the CFS. In case of M, we have 60%, we have 80% holding, so 20% stake is with NCI. So we have to take their consent also. Is it right? But for entity Y, it is a wholly owned subsidiary. So therefore, parent has no objection. Next example. where local regulations govern the participation of or write down preparation of CFS. Local regulations govern the preparation of CFS. Now, IFRS is a standard applied by many countries, but local regulations are also something which one has to take care of. There can be contradiction between IFRS and local regulation. Like for example, in India, Companies Act. But if Companies Act requires you to prepare CFS and they don't give you exemptions, then you will have to prepare the CFS. So at times local regulations dictate when and for what period an entity must prepare consolidated or separate financial statement. Local regulations means your local act like Companies Act. Local regulations might allow or require an intermediate parent to produce separate financial statement prepared in accordance with IFRS instead of CFS. So sometimes they may allow that some intermediate parent need not prepare CFS. Country to country the regulations can vary. So I'll just discuss that. You follow the local regulation in that case. Whether you have to prepare CFS or SFS, one has to also ensure that you don't violate the local laws. Come to para 4. What is CFS? CFS is financial statement of a group. Underline the word group. What is group? Parent and subsidiary. Option B, parent, subsidiary and associate. Option C, parent, subsidiary, associate and joint venture. A or B or C? The answer is A. Group means parent and subsidiary, in which the asset, liability, income, expense and cash flow of parent and its subsidiaries are presented as if it is a single economic entity. That is the beauty of CFS. Even though in the form there are 2 entities, 3 entities, but the financial statement is prepared as if it is one single economic entity. And what are the components of consolidated financial statement? Same, 5 components. Consolidated SOFP, consolidated SOPL, consolidated statement of changes in equity, consolidated cash flow statement and consolidated notes to the financial statement. When is this standard applicable? This standard is applicable when one entity has a control over the other entity. Okay. Control is the main guiding factor in this standard. So next few paragraphs we'll discuss about control. For maybe some theory question or some small case study, one has to examine whether control is exercised or not. To clarify any doubt, if you have, 50% is not a necessary condition for control, more than 50%, okay? With less than 50%, say 40%, an entity is holding 40%, but if it can satisfy the meaning and definition of control, that entity will also apply IFRS 10. And if you are holding say more than 50%, but you are not having control, then this entity can be exempted and this entity may apply. Okay. In this standard, there is no benchmark for control. In many other standards, like in India, there is AS21. There is a benchmark. If you are holding more than 50% share in the voting power, there is control and welcome to that standard. Here that 50% is not a benchmark. It can be a guiding factor. So we can say generally if you are holding more than 50%, we can begin with the assumption that there is control, but that can be challenged. If you are holding less than 50%, we can begin with the assumption that there is no control, but that assumption can be challenged and that entity may be required to prepare CFS. So control can become a matter of judgment in some cases. In the boundary line cases, it can be a matter of judgment, right? So what is control? An investor controls an investee when the investor is exposed or has right to variable returns from its involvement with the investee. They write such a complicated line. Normal student finds how to interpret. That means he is exposed to risk and variable return. He is exposed to risk and variable return for his investment made in that entity. Either he can get a very high return also, but at the same time he can even lose his money. He is exposed to or has rights to variable return from its involvement with the entity. So he is exposed to risk and variable return. He can earn huge amount of money. He can lose his wealth. Example of variable return can be dividend. Okay. And second thing you have to remember about control, an investor controls an investee when the investor has ability to. He should have ability to affect those return through its power over the investee. That means he has got so much power, then by exercising his power, he can influence the return. By exercising his power, he can influence the return because he can take decisions relating to relevant activities. Is it right? Since you have the power to take decisions relating to relevant activities, you have the power to affect the variable returns. Now, in theory it looks simple, but practically it can be a challenge sometimes. When three partners are holding 30%, 35%, 35% share in the company, finding who has the control can be a challenging exercise in that case. So one has to see who has the power to affect the variable returns in the most significant manner. If there is no control, then check whether there is joint control. Accordingly, that standard will become applicable. Now, one or two small definitions we will see, and then we'll go to the consolidation part. Who is a decision maker? An entity with decision making rights is a decision maker. Paragraph number 7. And that entity can be either an principal or entity can be an agent for other enterprise. Because the standard talks about decision making power. What is a group? Group means, once again, parent and subsidiaries. Who are NCI? Who are non-controlling interest? So non-controlling interest is equity in a subsidiary. Okay, this portion, which is not attributable to parent directly or indirectly. Directly means parent may own the stake. Indirectly means through its subsidiary it can own the stake. Okay. So in this chapter, there is one important calculation which will check whether you have done the problem right or not, is to find out the correct value of NCI. Both in SOFP also and SOPL also. In SOFP, Statement of Financial Position, you have to present NCI value separately. Sir, why? Because this gives us an idea about what is the value of NCI. What is the worth of NCI? Suppose NCI is 20%. In case, let us say, if I have to acquire their stake, what is roughly approximately the amount that I need to pay them? So that gives me a rough idea about the worth of these outside stakeholders' money. Okay. And then we have to also calculate the NCI share in the group profit. Out of the total profit of the group, how much belongs to outside shareholders of the subsidiary? That is to be presented in the statement of profit and loss. Who is a parent? Parent is an entity that controls one or more other entities called subsidiaries. What do you mean by power? Tick mark, power. Because the standard talks about that you should have the power to control, direct the relevant activities. So power means existing rights. Power means power comes from rights. Which right? Existing right. Existing rights usually come from voting power. Existing right comes from voting power, or existing rights comes from contracts that give the current ability. What is current ability? As of now. As of now. Say for example, the example of current ability would be your potential voting rights also. Say you are holding warrants which can be converted into shares at any time. So even that will be considered in checking whether you have the current ability or not. Suppose you are already holding 40% share and through the warrants you can get 11% share, and you can exercise the warrant at any point of time, which will give you 51% stake in the company. Even that will be considered in checking whether you have the current ability or not. So existing right, which will include the voting rights, contracts, potential voting right which can be currently exercised, that give the current ability to direct the relevant activities. So many words they have used. To direct, that means you have the power to tell the other party, please do it. Okay. And relevant activities. This standard have brought a new term called relevant activities. What is relevant activity? Substantially significant activities, in simple terms, which affects risk and return. You have so much power that you can direct the relevant activities, that is those activities which have an impact on your risk and return. For example, you can give direction relating to sales. Like for example, you can say that change the product mix. Okay. Change the product mix. Change your distribution channel. Change the discount policy, selling price. Then you can affect the purchasing decisions. Then employment related decisions. Which are the people whom you will employ in different key positions. So these are the relevant activities. R&D related activities, financing related activity, capital structure related activities, dividend related activities. So there is a definition also they have given. What are relevant activities? Activities of the investee that significantly affect the investee's return. So in every business there will be some activities which have an impact on your risk and return. So relevant activities and decision about relevant activities will include selling and purchasing of goods or service, managing of finance, selecting, acquiring and disposing of assets, researching and developing new product and services, and determining the funding structure or obtaining the funding. These are such decisions in the life of a company which can make or break the company. Okay, and you have the power to direct these relevant activities. Then you have the control. If you can control the decision making related to these activities, you have the control. Some more example they have mentioned: establishing, operating and capital decisions of the investee, then appointing and remunerating entities KMP or service provider, or terminating their services or employment. So these are the examples of relevant activities. The purpose of discussing the theory part is you should have a feeling that how the control is exercised. In IFRS, it is not because you are holding 51% share or more and you are having a control. Are you able to direct the relevant activities? Now, rights are of two types: protective right and second one, guess, substantive rights, non-protective right. Okay, that is your standard. Why are you sitting here? You should join IASB. Okay, what are protective rights? These are the rights that are designed to protect the interest of the party holding those rights. Are protective rights important in understanding the control? The answer is no. Protective rights don't give you control, because your right is only limited to those activities, those decision making area where you might be affected negatively. So there you can interfere. Other than that, you can't interfere. Like for example, you are a banker. Okay, banks normally have protective right. What banks do in their loan agreement, they will say, unless you return our loan, you cannot pay dividend. That is possible. Second, bank says, in case if you don't pay the loan, we will sell your property, plant, equipment. These are protective rights. Otherwise, they will not interfere. Whom to sell, at what rate to sell, who should be MD, etc. They don't interfere in those activities. So, without giving that power over the entity to which those rights relate. So, they have limited rights only to protect their interest. What is control? Paragraph next, paragraph 9, control. Control means an investor determines whether it is a parent by assessing whether it controls one or more investees. So to check whether you have control or not, check the following three elements of control. And if all the three elements are present, then you have control, and then the standard is applicable. First is, you should have power over the investee. How do I check the power? Whether I have the power or over the investee, do I have the existing right? Now, from where will the rights come? The right comes from voting power. The right comes from contract. The rights come from potential voting right. That give it the current ability. Actually, one word I think is missing here. That gives the entity current ability. Current ability means as of now. That means if I want today, I can do it. Current ability to direct the relevant activities. So 3 points are covered here. Investor has existing right, investor has current ability, and investor has the right to direct the relevant activities. If these are present, you have the power. Okay? Second thing is that to have control, you should be exposed to or rights to variable returns. That means, as I have told you earlier also, you are exposed to risk and variable return. You may earn a lot of profit, you may even lose your entire capital also. And the third is, the power, you should be able to use that power. Only power is not enough. Power should be used. Like all of you have power to become a rank holder, but that power has to be used. Okay. So the ability to use that power over the investee to affect the amount of the investor's return. So if these three elements are present, you should have power exposed to variable return, and ability to use the power to affect the return, which will indirectly affect your return only. By affecting the investee's return, you are also affecting your own return. If they earn more profit, you will get more dividend or more capital appreciation. So now let us discuss about rights a little more. Rights that give power to direct the relevant activities. Power arises from rights. But how do we get the right? Sometimes the rights are straightforward. Rights are straightforward means you simply hold the equity share of a company, one share, one vote. So we can calculate how much voting power you have. If you have more than 50% voting power, it means you have almost the control, because you can take all such decisions which require a simple majority. Especially you get the power to appoint the board members. With that 51%, more than 50% share, you can appoint the board members. So then we can say, yes, you have the power. Or sometimes the rights can be complex. For example, it may be in the form of contracts. Then one has to read the fine prints of the contract and check whether the contractual arrangement gives you the power or not. Okay. The current ability can flow from contractual rights or voting rights. Even there are contracts which gives you the power. If you want to raise money, if you are a fresher, startup, you want to get money, what will you do? You will go to the private equity investor, venture capital people, and those people are smart. They say, we will give you money. Okay, although my stake will be 30% only, the entity will have 70%, but I will appoint 4 directors out of 6. Now, 4 out of 6 means you are almost virtually going to control that company. So, but that is through contract, not through voting power. Or any such example where the contract gives you the power to direct the relevant activities. That is why many companies prefer not to take money from others, because by giving control, you just have to follow their instruction. Is it right? Such rights should further be assessed as to whether these rights are substantive rights or protective rights. Protective rights will not give you power to control. Substantive rights will give you power to control, because protective rights have limited purpose. They are going to protect the interest of the party only. In case if the company goes against that party, otherwise that party will remain a passive partner or stakeholder in that company, like an investor who has provided loan. And the loan agreement says, if you don't repay the loan, then I will sell the asset. Till that time, you are paying the installment on time, he is not going to use that right against the company. While investor with substantive right has the power over the investee. Now, I have also written some example of substantive right. Like for example, this is one of the substantive rights one has to check, whether you have a right to appoint or remove the board of directors or key management personnel. Because these are the ultimate people who take the decisions on behalf of the company. Is it right? Once they approve a decision making, all juniors, subordinates, they have to obey it. They decide how much dividend should be paid, merger, demerger, buyback, acquisitions. Then right to direct investee to enter into transaction for the benefit of the investor. So if you have the power to direct the other party, to enter into such transaction which will benefit you directly, then you have the power, substantive power. Okay, like practically you will see, they ask the subsidiary, you manufacture this product and supply to the parent company. Even though this may result into loss to the subsidiary, but subsidiary manufactures that product at 90 rupees and sells it to the parent at 65 rupees, but then he has to do it. So you have that much power that you can force the other entity to enter into transactions which may benefit the investor. And what are the examples of protective rights? This example I have repeated. Lender's right to restrict a borrower from undertaking activities that could change the credit risk of the borrower to the detrimental of the lender. So example would be, you will not pay dividend till the loan is repaid. Keep the cash flow with you. You will not borrow more money. Lender can put one more condition, we will not let your borrowing level go up further. Then he can put a condition, you will not enter into a merger or a demerger transaction. Such corporate restructuring cannot be undertaken either till the loan is outstanding or without the prior approval of the lender. Another example of protective right, you will seize the asset of the party if he fails to repay. The standard knows that sometime it may be difficult to determine whether investor rights are sufficient to give power over an investee. That means it may be difficult to prove the control. Then some additional factors should be considered. Additional factors like, this is one very key factor one can consider, the power of the investor to appoint or approve the appointment of key management personnel. This is an example of substantive right. Check whether that is available. Whether the investor can direct the investee to enter into transaction for the benefit of the investor. Already discussed. Now these are indicators to check whether there is a control. Whether the investor can dominate the nomination process for electing members of the investing governing body. This is also very important power. You are dominating the nomination process for electing members of the investee's governing body. That means you have a major role in deciding who will be the board of directors, who will be the members in the committees, important committees of the company. It means you have the control. And whether the investees KMP are related parties of the investor. So many times in some companies I have seen, they will put their key management personnel as a director in the other company. That means these directors are your brains and eyes and ears, and they are just instructing the subsidiary company as you want them to instruct. And whether majority of the governing body of the investee are related party of the investor. That is also assigned. Majority of the directors are KMP of this company. KMP is a related party. Under IS 24, para 9A3, is it right? 9A3, 3 related parties in 9A and 8 related parties in 9B. Tomorrow I will ask you to check whether you remember or not. Okay. Now next is exposure or rights to variable returns. The entity must be exposed to risk. That is, your return can be variable. You may earn a huge amount of money because of your association with that other entity, or you can even lose your capital, lose your investment. So that is called exposure to variable returns. Example of variable returns: dividend, remuneration for the servicing assets and liabilities, residual interest in the investee, and access to future liquidity and return that are not available to other holders like cost savings, and access to proprietary information also. Because you have the power, you have all access to Proprietary information is usually not available to public, like their R&D information. They may have some technical know-how, so you may have access to those information. You should have power to direct the relevant activities, and you must be using that power, right? So there must be a link between power and return. Parent should not only have power over the investee and exposed to variable return, parent must also have the ability to use its power over the investee to affect its return from the involvement with the investee. Now we will continue tomorrow, and then tomorrow first we will discuss the consolidation procedure, line by line, all important adjustments that are usually asked we will discuss, and then a long list of problems will start. Now we'll continue tomorrow.